right. Well, everybody, I'd like to introduce you to Ann Inman from my office at the Small Business Development Center. Ann is a consultant in our office, um, Ann works with hundreds of businesses as they start up, but Ann is also particularly qualified for tonight's topic on key financial indicators for starting your business because Ann is a former certified public accountant. She's got an undergraduate degree in accounting and an MBA. So tonight, remember, is just an overview of all of these key principles. So if you've got questions, feel free to put them in the chat, and I'll be monitoring the chat for Ann. So I'll either try to answer them for you, or we'll interrupt Ann and see what she has to say about it. Okay. So without further ado, go ahead and take it away, Ann.
Thanks, Michelle. It's such a privilege to be with all of you tonight. I'm really looking forward to having a conversation about financial matters that relate to starting and managing your business. So before we dive into the good stuff, just a quick overview on housekeeping. And I know you've all seen this many times, but please do keep your cameras on. That's really helpful to me and for everyone else to see each other as we try to maximize our engagement here tonight. Michelle, as she mentioned, will be manning chat. So if you've got questions, please throw them up there on chat. And again, just try to mute yourself if you're not talking. And then it looks like everyone's done a pretty good job of changing your name and your business idea. But if you haven't, please do that as well. Okay, so let's get going. Here's our first slide tonight. This is meant to be a little fun, but at the same time, we get it. Like this topic of money and math as it relates to your business. It's often intimidating to a lot of folks, particularly as they're starting a business for the first time and may not have a background relative to business. This can be a new topic and it can be a little overwhelming. So just for fun, in all honesty, can anyone relate to this pain scale here? Does anyone out there feel like they're kind of somewhere in the orange or the red, or are we all feeling good in the green? I see some fives. All right. We get it, right? And our goal tonight, realistically in an hour, we're not going to get everyone over to our little smiley face friend at zero, at no pain tonight. That's not our goal. Our goal, though, is to shift everyone to the left of wherever they may be. You know, no sugarcoating here. This topic is critical. While it can be intimidating, it's so important for everyone to manage their business. It's okay if it's not your favorite part of managing a business. We all have inherent strengths and preferences as it relates to our businesses. But as a business owner, you need to have a basic understanding of the mechanics of running your business from a financial standpoint, especially when it comes to managing cash. And we're going to spend a lot of time tonight talking about this idea of cash flow and managing cash flow. Another point on this too, you know, you don't have to be an expert, and at some point in your business journey, you may choose to outsource some of this. You may choose to outsource your payroll, you may choose to outsource your bookkeeping or your taxes, and all that's fine. There are a lot of great service providers and a lot of tools online that can help you with that at varying price tags, right? But the point is, even if you choose to outsource this, you're the quarterback of your business, and you need to have a foundational understanding of really these key issues so that you've got a good overview to make sure that all the pieces are clicking along in the right way. So we've got a lot of great material for you tonight. And again, our goal is not to make you an expert in an hour. These are meaty topics. As Michelle said, I studied accounting for 4 years, right? This isn't something that we're all going to master in an evening. But you know what? There are a lot of professionals in the area. There are a lot of tools and resources. You know, there's a lot of support out there to help you as you progress in your understanding of these topics. And I hope that tonight as well will not only give you an overview of kind of what's important and what some of those resources are, but give you the confidence that, you know what, you got this. You got to picture the landscape and you know where to go for help if you need it. So here's our roadmap for tonight. First, we're going to talk about the importance of good financial record keeping. And then we're going to dig into some of those key terms that relate to accounting and to financial statements. We'll then spend a little time walking through this principle of cash flow management. And then we're going to spend a minute talking about special issues from a financial standpoint that relate to starting a new business. And then last, we're going to do an overview of sources of funding. We're going to talk about some of the key sources of funding for new businesses. And just to set the stage tonight, this will be brief. The good news is you're going to have a whole section on this next semester. So we're going to set the stage for that and kind of give you a sneak peek, but definitely more to come on that next semester. So let's start with talking about record keeping. Why does good record keeping matter? Why it matters is because this is your ammunition for doing some really good fact-based management. And what do I mean by fact-based management? That means having the ability to plan for your business and manage your business and control your business based on really good information. I think we're probably all familiar with the expression of garbage in, garbage out, right? Same is true with running your business. You need to have good information from a financial record keeping standpoint so that you can make good decisions that are based on facts. And that's what we're talking about here. This is the goal. So not only for managing, but we also use good financial record keeping data to look towards the future, right? As business owners, there are going to be different times in our journey when we not only need to understand what's happening today, but we also need to use that information to maybe project what we think might happen next month or next year. Maybe when we're trying to get a loan, that's something that the bank's going to ask for. They're going to want to look at your projections. We can't have great projections unless we have really good information to build that off of, right? We can get data from the outside, but our internal record keeping and our internal data is our best source of really good ammunition for making accurate forecasts. Another reason why financial record keeping is really important is that we need to have a really good historical record of all of our business transactions. The financial record keeping is really the story of your business, right? It sounds a little hokey, but the numbers tell the story of your business, decisions that you've made, things that have happened, performance. So not only is that important from an institutional knowledge standpoint, but it also protects us, right? You may have challenges in the future. You may have an issue come up that you really need to be able to have information to help answer a question to divert a challenge. For example, we see businesses get sued at some point, right? We don't like to think about it, but it can happen. What's your best recourse? It's to be able to go back to your records and provide a great set of facts. That's just one reason why financial records are so important. Next point here is, hey, guess what? They're required in a lot of circumstances too. There are very prescribed record keeping rules for certain areas of business documentation. That has to do with taxes and other governmental regulations. We're going to spend a little bit more time on that later, but yet another reason why it's really good to have a good system in place now so that you're ready to meet all those requirements. And then last, I want to talk about valuation and value. You may get to a point in your business where you're looking to grow, and to grow, you need capital, whether it be from an investment or a bank. You know what? Most investors, and absolutely every bank that I'm aware of, want to know something about your business before but they're going to be willing to extend credit or cash to you, right? And how do we establish that? We tell the story of our business using data, using our numbers, right? And this is why it's super important to have really good, concise records of everything that's gone on so that we can share those. And then again, we can use them to project the future, which is also part of that. The last point here is valuation. At some point, you may want to sell your business. Good financial records help us demonstrate what our business is worth. And we all want to be able to do that, right? And the last thing here is the process itself of having a good financial record keeping system and continuing to keep good records also drives value. A business is worth more if it has really good processes in place so that a new buyer can look at it and feel good and confident about the records and the numbers that are being presented. Okay, so that's kind of the why, but now let's talk about how. How do we keep good financial records? The key to that is called an accounting system. And simply put, an accounting system is a collection of tools and processes that are employed by a company to collect and organize financial data. So kind of a big word, but that's what it is. It's the decisions you make around tools and processes to collect and maintain your financial data. So this doesn't have to be a big fancy system, particularly when you're starting out. This can be manual and it can be simple. That's fine. And it can grow as your business grows. It's a misnomer that it has to be automated and highly sophisticated, especially when you're starting out. The goal is to find out what the needs of your business are and then to follow it with your system. So whatever you choose, there are a few key requirements that I want to throw out for your consideration. Number one, whatever accounting system you choose, keep it separate from your personal finances. A lot of times when we're starting out, right, I had a consulting business at one point. It would have been very easy for me to pay my bills from my checkbook, right? Not a good idea. We want to keep that separate. One, because we want to establish the credibility of our business, right? We want to have a good historical business record, but we also want to start building credit for our business. And how do we do do that, it's by having a history of paying our bills on time and such. So really important so that you can keep your business separate from your personal finances. Okay. The next thing is whatever system you choose, keep it simple and easy to understand. There's no reason to overbake this cake, right? This should grow with your needs. And what I mean by easy to understand is you may have employees for your business, right? And you want everyone to comply with whatever accounting system you choose. So keep it easy to understand, keep it easy to use, right? It can grow with your business, but we just want to keep it as simple as possible. Next point here, these are 4 words that when you're thinking about making decisions about maybe adding a process for your financial record keeping, you should be thinking about. You want your system to be timely, reliable, accurate, and consistent. Okay. So what do I mean by that? That means like if we're going to, let's say we're going to start we're going to develop a process for our accounting system about paying bills. Okay, so what I mean by timely is let's get that process in place so that we do it routinely. So for example, maybe we pay bills every Monday. So now I know that I don't have any bills that aren't getting processed or paid because every Monday I'm looking at what's in the bin and I'm either paying it or I'm scheduling payment on that bill. That also makes it reliable, right? I know that I've got a process in place that's reliable to make sure that my bills get paid on time. Okay, consistent and accuracy. Accuracy could be that how do I know I'm paying the right amount, right? I want to make sure that in this process, I build in a step to make sure that the amount I'm paying is correct. So I may have in my process that before I write a check or paid a bill, I'm going to go to that invoice and make sure that the number that that vendor actually wrote on the bill matches what was either in the estimate or the invoice. That way I know that it's accurate and I'm paying the right amount. And the consistency is that this process, I'm going to write it down and I'm going to follow it every time. So those are just 4 key words that I want you to think about as you start to think about how you're going to handle accounting within your company. Of course, it needs to be tailored to your business, right? If you're a cash-based business, you want to have a lot of processes around managing cash, okay? Particularly around making sure that cash minimizes the number of hands that touch it, and that you're securing the asset of the business. If you're, for example, a business that bills everything, you're a construction company and you don't deal in cash, right? Maybe you bill at the end of a project. You probably don't need to have a whole lot of processes in place around actual physical cash, right? You would want to focus more on, okay, well, what are my processes for making sure I'm billing on a timely basis, right? Okay, last point here, and I touched on this in this last point about internal controls, but you want to make sure you think about safeguarding your business assets. And what I mean by that is you want to make sure that these processes take into consideration that we want to make sure that we've got security for the assets of the business. So what I mean by that, for example, is cash. Let's talk about cash again. One easy way to secure cash in a business is making sure that you've got 2 signers on a check, for example. Say you're a bigger company. I know some of us are just ourselves, and that's fine. But if you're a bigger company and you've got multiple people working in your accounting or your bookkeeping department, you probably don't want the same person reviewing the bills, writing the checks, and signing the checks, right? We want to make sure that a couple different sets of eyes see that so that we're maintaining control and integrity over our cash balance. That's just one example. There are hundreds, and there's lots of help out there when you get to that point, but just something you want to be thinking about, that are these controls safeguarding my business assets? All right, so let's move on to tools, right? So we know that developing processes is one part of an accounting system, but there are also tools. And there are 3 that I'm going to chat about tonight. And the first is a checkbook. And I know we're all familiar with this, right? But this is a fine way to start your business, keeping track of cash receipts and cash disbursements in your checkbook, right? And that's fine. As you grow, you may want to evolve into something a little bit more sophisticated, and that would be a cash receipts and disbursements register. It's a bit of a mouthful, but I'm going to show you an example on the next slide. And it's really a great tool. Again, it's simple. It's one step above a checkbook in sophistication, but really gives you an additional level of power in terms of analyzing where your cash is going and coming from. So stay tuned for just a minute on that one. And then the last tool here that I want to chat about is accounting software. And I'm sure that you're all familiar with hearing about some of these. QuickBooks is really the most common when we think about automated accounting software packages, but there are a lot more that are available. FreshBooks, HoneyBook, Wave, these are just a few examples. And if you're interested in going to an automated software, I would certainly encourage you to check out a few of these to see what functionality meets your needs and what price point meets your needs. QuickBooks, for example, even in itself, I believe has 3 or 4 different service levels and price points. And no need to go in and buy their highest package if you don't need some of the extra functionality that it offers. So for QuickBooks, for example, can help manage inventory, and you can create invoices out of that. Maybe you don't need all of that. So just do your homework and make sure that you're selecting a package that really just meets your needs and that potentially can grow with you as your business grows. Okay, last things to think about here. You want to think about your desired level of participation in these processes, right? How involved do you want to be? Absolutely, you need to be involved in looking at your cash balances weekly. We're going to talk more about that. But if you're feeling like, you know what, I don't want to be super involved in managing the day-to-day, either A, you want to outsource this, or maybe you want to move to an accounting software package that's going to make this a lot more automated. These are just some things to be thinking about. The other thing is your need for timely information. If you're in a situation where you need updated results all the time, maybe automated is the way to go. Last point here is, if you have a CPA you're working with, they certainly can help you evaluate your accounting system and help you tailor that to your business, and also help you make decisions for that to grow with you as your business grows. All right, so I chatted about the cash receipts and disbursement register. So let's come back and just talk about that for a minute. I've got an example here, and you can see it's just an Excel spreadsheet. And what we do down here is we enter all of our cash disbursements. So I've got a few examples here. I wrote down the date that I wrote a check. I wrote down my check number. I wrote the payee. So for example, this first one here is to ABC Property Management. I've got the dollar amount. And then over to the right, I've set up a column for each of my key kind of account buckets. And what I mean by that is, okay, well, what are those key accounts, are those key buckets where my company spends money? So then I'll allocate that expenditure within that bucket. So you see I've got it over here in rent. And the idea is you do this for every transaction. And then at the end of the month and at the end of the year, you can easily total what you spent in each of these buckets. And that's pretty handy because all of a sudden you've got the inputs for any reporting that you might want to do. If you want to put together a quick little income statement, easy because you've got all your key accounts already accumulated. Also really helpful for your taxes, right? Really helpful to either give to the accountant that's helping you or helpful to you as you're preparing your taxes for yourself. You can also do this for cash receipts, and then you can also spill out your credit card this way. And we have a great template that we'll make available to everyone after tonight. And if you choose to use this, great. It's got some instructions on the first tab. I encourage you to take a look at it and maybe give it a spin. You can customize these account titles to whatever your needs are, and it'll automate it throughout the spreadsheet. So again, this is just a great tool. It's easy to use. It's free. And if you've got nothing in place, this might be a really great place to start. Okay, so to wrap up on this record keeping topic, just a couple tips that I want to hit on. Support, the idea of financial support. Obtain and keep appropriate support for your financial activity. This is really important. At some point, you may be asked to provide support for the financial information you're reporting from either a bank or an investor or the IRS, right? So we want to establish these practices now so that we've got good processes in place, that we've always got the appropriate support that we need. And by support, what I mean is, let's say we've got expenditures that we're listing, right? We want to keep the document, the third-party document that supports that expenditure. For example, let's say I had an expenditure, I took a client out for dinner, right? I want to keep that receipt. And on that, I want to write the date, I want to write who was there, and I want to write the business that was conducted at that meeting. That's an example of one IRS reporting requirement or support requirement. So we want to get into that process of making sure that we're keeping all those third-party documentations for the cash that comes in and out of our business. Another example would be just for regular bills that you pay, right? Hang on to the bills so that you've always got a copy and you can go back and refer to that. But if there's an issue too, you've got that appropriate support that can back up the transaction. Okay, so this next topic goes a little bit well with the first point, but it's retaining those records from a record retention requirement. The IRS does have some very prescribed rules about what you have to maintain, so you want to develop that into your accounting system as well. So, for example, like a bank statement, all of our bank statements. I don't know, did anyone know that the IRS requires you to hang on to that for 7 years for your business? I didn't know that. Was like, wow, that's a really long time. So you just want to make sure that you've got a file somewhere and that you're hanging on to those, so that if an issue ever came up, you've got anything that you need. And you know what? These policies are readily available. So that might be something at some point you just want to take a look at to make sure that you're hanging on to things. So like tax returns, for example, those you want to hang on to forever. Just want to just have a place somewhere to hang on to these important support items. Okay, this next point here, schedule these bookkeeping activities and stick to it. This is probably the hardest part, right? Because we're business owners and we're wearing, I don't know, a million hats and the list is long and the days are short. But really, really important to build these bookkeeping activities into a schedule, particularly looking at your cash balance, your cash ins and outs. I highly recommend that you build into your schedule looking at cash once a week, if not more frequently, right? Maybe it's Friday afternoon, maybe it's Monday morning, whatever works for you, but build into your schedule and build it into your routine so that you're consistently doing that on a weekly basis. There's some activities that are monthly activities, and some you may not need to do, only a couple times a year. But the idea is let's identify these things that are really important and get them on the calendar and then stick with it. Okay, last point is key duties here. And this we chatted about, but if you've got a staff as your business grows, be really clear about who's on first, right? Who's expected to do what functions and when are they expected to do that? A lot of times it's really kind of easy to assume that, well, because Sue does that every week, she's on it. As a business owner, you want to make sure that you're really clear about everyone's responsibilities and that they're getting done. And you can outsource some of that too. We talked about that earlier. You don't have to do everything yourself, but you've got to have a plan for everything gets done.
Hey,
Okay.
and
Yeah.
just a quick couple things in the chat that I think you should
Sure.
note. First is Prenicia mentioned Cam Scanner is a great resource just to keep track of stuff, and she also said she uses a Google folder with everything in one spot.
Perfect.
And just as you kind of keep going on, Renisha asked a little bit more information about owner's draw, and I did put some an answer to that question in the chat. But just as you go, Anne, if you come across that term again, owner's draw, just to make sure you're covering that. Otherwise,
Absolutely.
I think we're on it otherwise.
Okay. Thank you. Thank you.
Yep.
Yes, we will definitely talk about owner draw. It's coming up. So, um, next topic, we're going to dive into the statements and some key terms about the financial statements. So we're going to start looking at some numbers here. Before we do that, just a quick reminder, we're not going to absorb everything tonight, right? And that's okay. We want to have an understanding of the overall landscape and a high level view of these important pieces here. We're also going to provide, as we continue to go on sightlines, to lots of resources within our local community. We're so lucky here in Madison to have so many great resources. Again, just reiterating that expectation so that we cannot feel overwhelmed and stay focused on being at the start of this learning process here so that you can get these foundational understandings. So in terms of organization, we're going to talk about the primary financial statements, the big three. We're going to talk about key terms that relate to each of those statements. And then we're going to do a walkthrough of a cash flow management tool that we're going to share with all of you. And then last, we'll round out this topic talking about just a few startup specific issues and terms. So let's dive in. The financial statements, the big three. The big three financial statements are the income statement, the balance sheet, and the statement of cash flows. So let's start with the income statement. The income statement is a report that lists sales, expenses, and net profits for a given period of time. And its focus is primarily on the operating performance of your business for that period. It's a prescribed period of time. A balance sheet, on the other hand, is a snapshot of the business's financial health at a specific moment in time. It really focuses on what a business owns and owes at that particular point in time. And we're going to unpack each of these. I just want to give you a little view of where we're going. And the last here is a statement of cash flows, or the cash flow statement. And it shows the cash coming in and going out of your business during a specific time period, including where it came from and how it was spent. The other point I want to make here, and you can see this little wheel, that all these statements are interrelated. One feeds the other, okay? Um, how they work together can get a little complex, and we're not going to spend a lot of time on that tonight. I just want to, everyone understand that none of these operate in a vacuum. They all work together. All right. So why are these financial statements important, right? Again, we're going back to that concept of fact-based decision making. This is really the cornerstone of good financial management. This is where we compile the information so that we can make good decisions. The other reason is that these financial statements and the big three, right? These aren't just something we use at the SBDC or in Madison. These are used by public companies, everywhere. This is a consistent language, these financial statements, and I shouldn't say everywhere. The accounting treatment can vary a little bit internationally versus the US, but definitely in the US, public companies are all required to use a consistent format in these financial statements. There's a governing body called GAAP, or Generally Accepted Accounting Principles, right? And they make the rules. Their job is really to set policy and make the rules on what is the consistent language or the consistent approach to communicating financial results through these financial statements. And why that's super important is if you think about all these public companies out there, right? How would an investor ever know or ever be able to evaluate one company versus another, or to know that the financial data that they're representing is accurate? We really rely on the fact that the format of these financial statements and the rules for how things are reported are consistent. We rely on that so we can compare apples to apples. Otherwise, we just never would have the confidence that we were looking at consistent information. So that's just a little background on why these financial statements have evolved the way that they have, and why this is a consistent language across business. So another note on that too, does that mean that you have to follow GAAP today and create these 3 financial statements at the end of every year? No, absolutely not. There are a couple where there's some choices that you can make. If you're a public account, sorry, I'm getting ahead of myself. I'm getting excited talking about accounting. Sorry. So if you're a public company, right, you don't have a choice. You have to report every year. You have to report all 3 of these statements. And there's another one that's often considered the 4th, which is a statement of owner's equity. And this is the way you report. If you're a private company, you absolutely don't have to report these in the same manner that a public company does. And particularly for small businesses, a lot of times they'll start with an income statement. Many small businesses don't have a balance sheet. In terms of best practices, do we recommend it? Absolutely. But if you're really going to focus on one as you're starting, it's looking at your cash flows on a weekly basis, then maybe it's your income statement. So before we move on, I want to talk a little bit about accounting method, because this kind of relates to this whole idea of uniform financial statements. There are 2 primary methods for accounting for sales and expenses in your business. One is called the accrual basis, and the other is called the cash basis. And the big difference between these is when you record the sales, when the cash is received, that's how we do it in the cash basis. So if cash comes in the door, that's when I record the sale. Or in the accrual basis, we recognize revenue and expenses at the time of the sale and not necessarily when the cash comes in the door. So let me give you an example, because that's a little confusing. If I'm a coffee shop, and let's say that my sales, I receive cash at the time of sale, right? I slide the coffee across the counter and I'm getting paid right away. I may choose to use the cash basis of accounting because it's super simple. And I'm going to recognize all of those sales when I literally have the cash. That would be an example of the cash basis. There are some other companies, though, where the accrual basis is much more appropriate. So we work with some construction companies in our office. And the way construction works is their jobs typically take a long time, right? They're multi-month projects. But they wouldn't be able to survive if they didn't get paid until the very end of the process. So they may get paid in tranches throughout the process. And their bills may be coming in at totally different times. They have to pay materials and pay their suppliers. And keeping track of that, the differences in timing, if you're on the cash basis, that can really distort where you are from a financial position. So what the accrual basis allows you to do is to recognize those sales. So percentage of completion is a word that would be used in that industry, and those expenses, for example, as they occur. And the benefit here is we have a much better picture of where we are from a financial standpoint. So really, just wanted to introduce you to the concept that there's a choice here for most of us as we're starting out, and that you can make a decision based on your short and longer term needs. And if you need some help with that, making that decision, that's certainly an appropriate question for an accountant or for one of us, and we can chat about that further. Okay, so let's talk about the first of the big three here. This is the income statement. And as I mentioned, this is focused on the operations or the operating results of your business. And this is reported on a consolidated basis. It's consolidated sales, expenses, and net profits for a given period of time. We typically look at an income statement at least on an annual basis, right? But best practices, we're looking at an income statement on a monthly basis. All right. So other names that you may hear thrown around for this, a profit and loss, or a P&L, or a statement of financial performance, earnings statement, statement of earnings. These are all the same thing. We're talking about the income statement here. So how do we use the income statement? This is really what we use to look at our revenue and our key expenses at an aggregate level for the company, okay? We like to look at this so that we can see how we're doing versus some key benchmarks. So typically we might look at our performance versus our budget, or it's really typical to see an income statement presented like I have right here, where we're looking at our performance versus the prior year. It's very typical to show multi-years on an income statement so we can see how we're doing. Lots of key terms on this that I want to point out. So let's start here at this example I've got for Larry's lawn cutting on the top line here, which is our sales line. This is sales for the reported period. So this one is the year to December 31st. This is an annual period. And this will either be called sales or sales revenue. Sometimes you'll see different revenue streams broken out separately. That's completely up to you if you want to set this up in a way that's going to be most meaningful to you. Another time you may see another concept I want to introduce is the idea of gross versus net sales. If you see net sales on an income statement, what that means is that business may have, they may track returns, for example, separately and show sales net of those returns. So just want to clear up what that might mean. The next item here we have is cost of goods sold, or COGS. You might hear that thrown around a lot. And what this is, these are direct costs related to whatever it is you're selling, whether it be the production of what you're selling or the acquisition of what you're selling. If you're a retail business, it's that inventory cost. Okay, so these are direct product costs. It's your cost of goods sold. Gross profit is the next line moving down here, and this is simply sales minus cost of goods sold. So this is a standard term that you're going to hear a lot, like, well, what's the gross profit for your business? That's what we're talking about here. You may also hear this referred to as the gross margin. All right, so moving down here, we've got our operating expenses, and these are the expenses that are the ongoing expenses that are necessary to keep the business going, but they are not directly tied to products. So for example, in this example, we've got like bookkeeping, right? That's a great example here. We absolutely need to have a bookkeeping expense to keep the business operating, or for secretarial services, for example, but we cannot tie those directly to the product line, which is lawn care in this business. So we call those operating expenses. Another term that I want to mention as it relates to expenses is the idea of fixed versus variable costs. Variable costs are similar to cost of goods sold, okay? They fluctuate with increases and decreases in production. So this would be things like direct materials or direct labor or inventory, whereas fixed costs are those costs that stay constant from month to month, and they don't fluctuate with sales. These would be similar to our operating costs like rent and salaries. Generally speaking, we can use these interchangeably. You know, there are some more sophisticated companies with sophisticated accounting systems that there could be some variance, but for our practical purposes today, we can use those words interchangeably. Okay. So let's keep moving down the line here and we get to operating income. So this is the income that's available to us after spending all of those fixed and variable costs, okay? We're not quite to net income yet. We may have some other expenses that we need to take out here, like interest expense, or this is where you may also see something like a depreciation expense. These are the last grouping of expenses before we get to net income. So net income also may be referred to as net margin or net profit or the bottom line. Something that we hear a lot about when we talk about income statements is top line and bottom line. And really, we accountants, we are not creative one bit. You'll see here that top line sales, guess what? It's the top line on the income statement, right? The bottom line is net income. And that's where those expressions come from. Okay, so a couple other things I want to point out before we move on here. So what do we do with this thing, right? Like we use this to look at how we did versus our budget and how we did versus year ago, but we can also use this for some great comparables. And we want to, when we talk about comparables, we may want to compare ourselves to like some industry norms, for example. And what lines we really want to focus on for that, you'll typically see gross profit compared to industry norms, and then of course bottom line or our net income is something that we may compare to industry norms. And there are lots of sources where you can get that information in the library, some industry reports. Is this critical? No, but does it help us understand how our expenses are lining up relative to our industry? Yeah, so that can be pretty powerful. And I just wanted to make you aware that there's some tools out there that if you're interested in doing that, that we can certainly help connect you with. All right, one last term on here, and that is break even. And the other thing that, the other word that describes this, sometime it's called your nut. So if you hear that, I just want you to understand what that means. Break even sales are the dollar amount of revenue at which your business earns a profit of zero. Okay, so what this means is it's the amount of sales that exactly cover your underlying fixed expenses of the business, plus all of the variable expenses related with those sales. So this is really important, right? We want to know as we're starting out or as we're growing, okay, what level of sales do I need to hit to make sure that I'm breaking even? That's how that term is frequently used. Okay, we're moving on to number 2, the balance sheet. So, as I mentioned previously, the balance sheet is a snapshot of the financial health at a specific moment in time. And typically we look at the balance sheet at the end of the year, okay? So what's great about the balance sheet? It helps the business determine its financial strengths and weaknesses and capabilities. And also really it helps us, again, communicate our business's financial health relative to the industry or relative to some norms. You may hear the expression ratio analysis. That's something that that a bank or an investor may look at. So kind of some key ratios when they want to evaluate the health of your business relative to others in the industry. So for example, if you're going in for a loan, they may look at the debt that you already have on your balance sheet, just so they can determine your ability to take on future debt. So that's just one example where they may use the numbers on your balance sheet to help evaluate the health of your business. Just to back up from a really holistic standpoint, the balance sheet we like to refer to as the statement of what we owe and what we own, okay? And from a mechanical standpoint, there's this basic accounting equation, and what it is that assets, which I've got up here at the top of the business, that's what our business owns, okay? So those are things like cash and accounts receivable, it might be equipment, it might be land, all the things that the business owns. So assets are always going to equal what the business owes. And what I mean by business owes, we can break that down into 2 buckets: liabilities and stockholders' equity. And these again, this is common language, right? So liabilities are outside obligations of the business, and this could be things like accounts payable, which is the listing of bills we owe essentially at any point in time, or income taxes payable, or debt. Those would be all things that we owe. And then the stockholders' equity are the ownership rights that the ownership group of the business has on the business. So we owe it, but that's what we owe to the ownership. So if you to really boil it down, what the assets or what the business owns always have to equal what the business owes. That's the basic accounting equation. So, last point I want to make here, we talked about how all this stuff works together, right? That's the other part of this equity equation here, that this gets updated at the end of each year based on the operating results that come from the income statement. And we won't get into the details of how that work, but I just wanted to help make the connection here that the operating results come into the balance sheet at the end of each accounting cycle, which is typically a year. All right, so now we're on to statement number 3, the statement of cash flows. So before we talk about, I want to hit pause a minute and unpack what we mean by cash flows, because we throw this word around and we've got statements about cash flow, but what does that mean, right? So cash flow is it's a super important topic in managing your business. So I want to be super clear here, and it's really simple. It's literally how cash moves in and out of your business. Okay. And we chatted about this earlier, but sales and cash may not be the same thing. If you're a cash business like a food cart or coffee shop, sales and cash might be exactly the same or extremely similar. But in other businesses, we know that it's not the same. There might be a big lag between when we bill and when we actually get paid. The idea of cash flow management, let's strip all of that away. We want to boil things down to the point so that we can really look at literally when cash is coming in and cash is coming out of the business. So, why is this important? Bottom line, we no cash, we can't run our business, right? If we don't have sufficient cash to meet our obligations, to pay our bills, to pay our payroll, we no longer have a viable business. And it's really sad, but we've seen companies fail. That some companies that report sales, but that don't manage their cash flow well, right? They're different. So it's really, really important that as a business owner, you've got just a laser focus on cash flow management. So what we're going to do in a minute is I'm going to show you a tool that we're going to share that hopefully will be helpful to you in getting started with cash flow management. But before we do that, I just wanted to spend a second on the statement of cash flows, because this is the 3 of 3 big 3 accounting statements according to GAAP. And essentially, what this does is it shows the ins and outs for the same accounting period, and it breaks these into 3 types of activities: operating activities, investment activities, and financing activities. If you're interested in reporting this, there's lots of information. You get a lot of help with this. But what I want to impress is that if there's a tool that's more helpful to you at this point, focus on that, right? This isn't a statement, and if the bank requires you to do that, great. But from my perspective, for a small business owner, it's important to pick a tool that's meaningful for you and that's going to be easy for you to maintain, whatever that be, whether it be this formal statement or something similar to this worksheet that I'm going to show you now. So this is just a simple cash flow budget worksheet. There are a lot of these out there. This is one that we like to use in our office. And like I said, we'll certainly make this available. But the idea is tracking out your projected cash flow activity. In a perfect world, we do this weekly, but if you want to start monthly, that's fine. And maybe your cash cycle isn't so tight that you need to do this weekly. Maybe monthly is fine. But the idea is to run those weeks or months, whatever you choose, across the columns here, okay? And I shrunk this down just so that we could all see it, but you can see here that I've got either 13 weeks or you could do 13 months, okay? But the way this works is you start with your beginning cash balance here. So let's see if I can figure this out. Whoops, nope, I was going to try to highlight and it didn't go so well. So I'm just going to point with my cursor. But you can see that I input my opening cash balance here of $10,000. Now, what I'm going to do is at the end of the week or the month, whatever accounting period you choose, you're going to update the spreadsheet with all of your cash inflows, okay? So let's say that you had a change in your accounts receivable balance of $2,000, okay? So that means you collected $2,000. We're going to include that as a cash inflow. Same thing with cash sales. You had sales of $4,000, great. We're going to include that as a cash inflow. Same idea down here, we come and we report all of our cash outflows. So I paid my payroll for $3,500, I paid my rent for $2,000, and I made a utility payment. Great. The idea is I now can add all of the cash coming into the business and then subtract out all of the cash going out of the business from an operating standpoint. And now we're going to talk about that idea of draw, right? So a lot of small business owners don't pay themselves via payroll. It has to do with your legal structure a lot of the time. And I like for my consulting business, for example, I was a single owner operated LLC. So I didn't worry about payroll. What I did when I needed to pay myself was I took a draw. And that's the term that we use if we are not using payroll due to our legal entity structure when the owner takes money out. Okay. So you can see here in this week that I took a draw of $2,000 because I needed to pay myself or I needed to pull money out of the business. So what we do then is then we add our total cash outflows here. And from that, we can see our ending cash balance. And really, it's just a really simple way to identify all the ins and outs of cash so that you know that at the end of your period here, what your ending cash available balance is. And then, of course, the idea is that then becomes the starting balance for the next week. Now, the rub here and what you want to do is you want to project this, right? So let's say that I'm going to start this next week. I want to put in my best estimates here for what my key expenses and my key cash coming in are, and then I update it as I go. And why do I want to look forward on this, right? Why do I not just want to input actual every week? It's so that I can plan. And I've got a couple cells highlighted here. In week 3 here, I know that I have to go out and buy a bunch of inventory. I'm a retail business and I have to go out and pay for a lot of inventory. Um, Guess what? At the beginning of week 3, I don't have enough money to pay for that inventory. So if I hadn't done some planning, week 3 would have been really rough for me because I would have been out of money. But by doing this kind of planning, I can see that I've got a gap in my cash inflows and I have a line of credit with the bank. So I know I need to take a draw so that I've got an ending positive cash balance. And that's what we're trying to do here. We're trying to make sure that you've got a tool so that you can understand both your actual cash needs and your projected cash needs so that you can manage cash flow with eyes wide open here. So there's some great tips out there for cash flow management as well. If you say, for example, start running into an issue where cash is tight, there's some things that you can do to help preserve cash. So for example, maybe if I'm cash strapped here, maybe I don't buy as much inventory. Maybe I start buying inventory in smaller quantities. Or maybe my customers, I start offering a discount for paying in cash or for paying early, right? That would be another way of managing cash. So there's a whole host of ideas there that really help with this idea of cash flow management. But just wanted to introduce you to this concept from a macro standpoint and let you know that there's some great resources out there. All righty. So as I promised, I'm just going to quick time check here. Wanted to chat about a couple things that just relate to starting up, just a couple terms that relate to starting a new business. So you may hear the expression startup costs. What are your startup costs, right? Just want to make clear that these are not traditional operating costs. Startup costs are kind of their own special thing. And these are one-time costs that are associating with starting a business. And I've got some examples here of typical startup costs. It might be, for example, if you're opening a franchise, it's that first franchise fee you have to pay. It may be a deposit that you pay on space. It may be furniture, fixture, and equipment you buy for your space. There's a whole list here that I just wanted to give you a pretty good understanding of what this could include. It's really important to keep really good records of your startup costs, okay? So keep a separate list, a spreadsheet, whatever works for you, of your startup costs. Couple reasons for this. One, you want to budget for these, right? So you've got your eyes wide open around what it's going to cost to start your business. And there's a lot of great information out there by industry of kind of norms for what it might cost to start a particular kind of business. So for example, you want to start a coffee shop, you can do some research to see what typical startups costs might include and what your expected range might be. That's really good from a planning standpoint, right? To understand what what you may be getting yourself into and to make sure that that's acceptable to you. Last thing I want to point out is that there's one startup cost that's often missed, and I don't want anyone to make this mistake, and that's working capital. We don't often think about that as a startup cost, but we just went through this whole exercise on cash flow management, right? We can't start with zero cash. We know when we start a new business, we're probably going to have to float things for a couple months until we have sufficient cash coming in. Really, really important to plan for that. as you're compiling your startup costs. You need to look at what your projected operating costs are for those first 3 to 6 months, and then plan to have access to that amount of cash, right? We see that sometimes businesses start and they're undercapitalized, and that's a problem because it's really hard to go back and ask for money again. Um, when you're just starting out. So that's my biggest tip is when you're looking at startup costs, just don't forget about working capital and make sure you budget some of that in. Last thing on why to do this, from an accounting treatment standpoint, like a tax time, startup costs are treated a little bit differently, so you want to keep good records of those. Last point here on small business or startup considerations. I want to talk about projected financial statements and then sources and uses of funds statement. Many of you may need to seek bank funding at some point for your venture. And if you're going to do that, banks traditionally want to see projections. And when they say, well, we'd like to see some projections, what they're typically looking for are 3 years worth of income statement, a balance sheet, and the statement of cash flows. Okay, the big three. They're looking for 3 annual statements, and then the first year they'd like to see that monthly. Okay, if you're trying to pull those together, SBDC certainly has some templates that can help with that. There's some great templates, Wibic. There are a lot of places you can go to get some help with that. I just want you to understand when someone asks you for that, that's what they're really looking for. The other thing that's really, really helpful is you're looking at startup costs is this idea of a sources and uses of funds statement. And what this essentially is it's just a simple listing of everything that's going to cost to start your business and then where that money's coming from. Okay, and those are your sources of funds or where the money's coming from, and then the uses of funds are everything that's going to cost. And this is just one example of what this report may look like. But what it does is it says, okay, if I'm going to start a business, I'm going to break out the things that I need. So for example, this business, I may need to renovate a building for my physical space. I need to buy some equipment. These are all uses of funds. Other uses of funds are some of those startup costs, working capital, that's down here, short-term assets, and then working capital, and then my initial inventory purchase. So this forces me to list out everything I'm going to need to get that business started, right? Those startup costs, and list those as uses of funds. Now, what's great about this is just like the balance sheet, this report balances, because guess what? If this is what I'm going to use all this money for, these are all my expenses, I need to identify sources of fundings, right, to pay for all of those. So what this does is it helps you break out where that funding is going to come from. So for example, how much are you as the business owner putting down? And then where are you going to get the rest? You can list out, are you getting funding from a bank or from friends and family, whatever. But it's a great tool for getting all of that in one place so that you've got a really good understanding of what your costs are going to be and your plan for funding your business. And this is absolutely something that the bank's going to want to see as well. This is part of that ask. Okay, so I will try to wrap up quickly here. I want to be respectful of your time, but I just have a couple more slides. As promised, I wanted to give you a really quick sneak peek on funding, right? So much more to come on this next semester, but wanted to just 2 slides here to just kind of set the stage. First, just expectations, right? We're going to talk about funding and what typical funding amounts are, but want to set the stage for most startup businesses, what they do in revenue and what kind of that average startup funding amount is. So the Kauffman Foundation is a foundation out of Kansas City that studies entrepreneurship, and they put out some great statistics every year. And from that, we know that 50% of startups have less than $100,000 in annual sales by year 5. And I don't know if that's surprising to you or not, but what we hear about in the press, right, are all of the Zooms and Chewy and Uber, right? These big startups that are just having the hockey stick growth and really just millions of dollars. But the fact of the matter and what the numbers reveal that only 4% of startups expect to generate $10 million in revenue by year 5. Okay, so just setting the stage, right? And industry matters a little bit. This, of course, varies by industry. If you're going into high tech and some of these industries where we see a lot of this this exponential growth, yeah, you may expect more in terms of return, but that's just something to take into context as you're looking at what you should expect out of your business. On the funding side, right? I don't know if you guys watch Shark Tank. I do, but guess what? Not everyone's getting a Shark Tank investment out there, right? They make it look kind of easy, and that it's easy, that you can just ask for it and get that. No, what we're seeing is that the average amount of startup capital is $25,000, and there are, like I said, 4% of startups generate 10 million in revenue. I think that it's 1%. I don't have the numbers in front of me, but 1% actually get what we call angel funding, and 3% get venture funding. And those are the investments that are just really huge. So in terms of deal flow, it's really a small group that are getting that level of funding. Most of us, or most small businesses, are funding their businesses with personal investment. So credit card, bank account. I'm sure some of us can relate to that. I can. Or maybe getting investment from your friends and family via a loan, or maybe a gift, or maybe it's equity that they want in your business, and then bank loans, right? So really about 40% of business funding comes from bank loans. So that's a really big percent. All right, so just really quick, as promised, here are some really common sources of funding for startups. And these are color coded for a reason. These up here in green are where most businesses start. As I mentioned, we start with ourselves, right? That's where I started my business. We may start with a credit card. We may get some funding from our team, or moving down, friends and family. And then again, most businesses, back to that 50% plus, we may borrow some money, right? So these are pretty common sources here. You'll talk about next semester when we talk about borrowed capital, bank lending, lots of details here. There are also some products available through the SBA that encourage banks to lend. There's an SBA program that provides some guarantees to the banks. Then the idea is to help reduce risk, so that they're more willing to loan money to qualifying projects. And then there's some other sources of borrowed capital as well that you're going to learn more about next time. Again, moving down this list really quickly, after exhausting this, some businesses may or may not look into crowdfunding. I'm sure most of us are familiar with Kickstarter, some of these more popular crowdfunding mechanisms. You're going to talk a lot about that, kind of how, if you do choose to go that route, how to make sure that you're setting yourself up for success with a crowdfunding campaign. And then moving down the list into the more rare, as we talked about, are the ideas of outside equity capital here. So that would be angel investors and venture capital money. And really the difference here, an angel investor is an individual, and it's an accredited investor. So it's someone with a high net worth that's using their own money to make an investment in your business. Venture capital is pooled money that's managed by a paid fund director. But what's different about these folks are looking to invest in your business, and they're looking for a really big return. They're looking to exit, right, for your business to sell, so that they can get their money out, and they're looking for at least a 10-time return. So it's great if you can get this level of investment, but big expectations, and they're hard to get. Like I said, they make it look easy on Shark Tank, right? They make it look so easy and fun. It's not for the faint of heart. It takes a long time. It takes a lot of networking. And again, the fact of the matter is, very small percentages of new business really do get funded this way. I don't want to discourage anyone. If you've got a business that may be a good match for this kind of funding, great. Again, it's just about awareness and eyes wide open about some of these levers in terms of funding. And then just super quick, government and nonprofit, you'll see in parentheses here, generally speaking, there's no free money. Again, this is one of the eyes wide open things that I hate to be the bearer of bad news, but the conception that, oh, I'll just get grant money, and there's all kinds of grant money out there. I wish, right? There is some, but it's typically very specific. It's tied, and what I mean by specific, it's tied to a very specific need or project, right? And if what you're looking to do with your business doesn't line up, you're just not going to qualify for that. So, and oftentimes it's tied with a match as well. So, for example, the city of Madison recently had a facade improvement grant for a specific area in Madison, right? That if you were willing to invest a certain amount of money in improving the facade of your business, they may match that. So it's an example of what I mean by very targeted, right? And matching. If you're looking for grant money, great to check with your municipalities to see what may be available. And then of course there's some other granting mechanisms, foundations in the area. If you're looking for that, it's important to see what kind of projects they support and then their grant cycles and application process. But headline here is, this is rare. I'm not saying it's not there, but it's rare, and it's something that you really need to research. So to wrap this up really quickly, I've got 4 takeaways. 1, record keeping is really important. Keep it simple, but start early and stick with it. Next, we talked about the awareness of key financial statements and terminology. There are lots of resources available for a deeper dive when you're ready. Number 3, no surprise here, actively managing cash flow should always be a top priority. So if I can leave you with one thing, my one thing, this is it. Make it a priority, build it into your schedule, right? And then last, we just did a quick flyby on funding. There are lots of options. Keep your mind on your goals and risk tolerance when looking at what you want to pursue. So thanks for bearing with me. We'll hang out for questions. And I hope this has been helpful introduction to some of these topics.
Thanks, Anne. This is Michelle. So everybody, I just want to say a couple of things really quick. We asked Anne to kind of hit the highlights, and the reason we did is because this is an overview of starting your business. And I think it's really easy when you're starting your business to get pretty excited about maybe your product, your service, or the marketing, and those are the fun things. Kind of back to that slide Anne showed in the beginning, the happy face smile or scale, and the numbers can be really, really scary. So I put in the chat that one of the things I would suggest that you do is take some time with this slide deck after and just go back over it and check out the terms and try to look at Anne's 4 key takeaways and spend a little time getting comfortable with some of those things. I think that'll be really helpful for everybody. So happy to have Anne answer any questions, but I just wanted to give that statement. And, it's really hard to kind of cover the financial aspect in an hour and however long we asked Anne to speak. So, but any questions anybody has?
Especially when you get so overexcited about accounting, Anne. It's really inspirational to see how excited you get talking about accounting.
Thank you, I think.
So how does some of that in and out of the cash flow affect like nonprofits? Because that's kind of like the different requirements for their reporting.
Okay, so what I would suggest then is you could set up what I would look at is, remember the buckets that are the columns. I would look at what are those reporting buckets that are required for you, and you may want to set up your buckets that way, or maybe there are 3 key accounts that you can add together and get to one line item on what you're required to report. That's where I'd start. I'd see, okay, well, what are they asking me to report, and then I can customize this template so that it easily matches up with that.
Thank you.
Yeah. Anybody else? It's a quiet group.
Hey, so I'm really excited about this. This lesson in particular is making me think like, all right, I'm excited about putting off starting the business for a while so that I can save enough and so that I can get that capital started. I was wondering if there were any tips for how to prepare for inevitably when things go off track or when something like I know that when people set a schedule for things, okay, if I want to make sure I'm keeping track of things every week, but when road bumps happen, what are what are good, I guess, what's good, I guess, triage for like, okay, something is unexpected. What are,
Yeah.
are there any tips? Are there like any examples? I wasn't sure.
Yeah. Really, the biggest tip I can give you is to build a contingency into your budgeting. Right? It's not fun, but it's really important to have a cushion for yourself, because at some point every business is going to hit a rough patch. It's inevitable, right? We can do our best planning, but there are things out there like a pandemic that we can't predict, and that's a terrible example because I don't think anyone could have had a sufficient contingency for a pandemic, right? But they're going to be smaller bumps that we want to make sure that we've got some funding tucked away somewhere, ideally that can help us get through that rough patch. And from a process standpoint too, right? Like, are you going to get it all right the first time? No, and that's okay. That's okay. Start, right? We can improve. We learn from our mistakes and we keep improving these processes as we go forward. The idea is to start, be deliberate, and then put it on your to-do list to make sure you're checking in on some of these things.
Excellent. Thank you.
Yeah, of course.
Hey, Anne, excuse me, I have a question regarding the cash flow.
Mhm.
When you're looking to do your projections,
Mhm.
how far out would you recommend going?
So two things, like projections for the bank projections or just cash. Okay.
Cash.
I like to go at least a year. I mean, really best practices, right? Like, let's talk about best practices. We'd have a monthly one that goes out a year on some of those bigger bucket items. And then I'd have a 13-week one to look at more of my day-to-day.
Cool.
The reality is, does everyone have time to do that? Probably not. So pick what you feel like you can start with, but that really is truly the best practice.
Great.
Mm-hmm. Whole idea is so that we can anticipate, right? And plan for those expenditures that are coming up.
I have a question.
Mm-hmm.
Is it normal for banks to have a preference of how much equity you have in your business?
What a bank, and you'll learn more about this next semester, but typically they want you to put between 10 and 20% in. So yeah, they typically want to see that the owner is investing in the business as well. It's very unusual. Well, in fact, I've never run across a situation where they're granting a loan without some equity. Now, does it have to be cash? Not always, right? So if you've got a piece of property or something, they may look at that as equity. But you need to typically expect between 10 and 20% is the general ask there.
Okay.
Mm-hmm.
So is that in between 10 and 20% of the amount of the loan you're asking for?
Of the project, right? So when we talk about, I'm trying to find out, sorry, I'm trying to see who's speaking, but so when we talk about back to the sources and uses of funds, right? That idea, that whole uses of funds is so we get the total of what getting this business off the ground is going to start, right? The total startup costs, the total uses, and then the sources, the 10% or the 10 to 20% would be of that total. Does that help?
Yeah, so if you have a $100,000 project, they want you to have 20,000.
Yeah, between 10 and 20. And that's generally speaking.
I have another question.
Sure.
Is it normal to see a business be successful or survive without seeking outside funding?
Absolutely. There is no rule that you have to seek outside funding. It really comes down to what scale are you looking to achieve here, right? So I'll go back to my consulting business, right? I was not a big business, and I didn't have a lot of outside costs. So I didn't have to get debt funding, which was great. But I also wasn't ever on that scale going to be one of those businesses that was pulling in $10 million, right? So for a business that's looking to achieve that level of growth or scaled growth, you've got to spend a lot of money to get there, right? There's equipment, there are all those costs that go with it. So for a business of that scale, yeah, they're more than likely going to bring in multiple sources of outside funding and at different times as they grow. So it really just depends on the type of your business and what your goals are.
You know, one of the things that you may consider for a smaller business too is that you might not need to take out a big loan, but you might need things like a line of credit or a credit card that has a bigger balance on it. Because let's say you do consulting and you're billing people and they're supposed to pay at the end of the month, and you still have bills coming in, but they're late, they don't pay. So you might not need a loan per se, a big loan, but you might need some access to some short-term cash.
Yeah, thanks, Michelle. That's a great point. Yep. And that goes back to that kind of that contingency planning, right? We want to look at our cash needs, and if we know we've got slow payers, we need to have a plan, whether it be a line of capital or we've built up a reserve, but it's having a plan.